Hello, and welcome to another episode of Reflections on Investing with the Cornell Capital Group. And if you happen to watch some of our earlier reflections toward the beginning, we talked about the fundamental valuation equation. And to review, that said that the price of a security, like a stock, should equal the present value at the risk-adjusted discount rate of expected future earnings. But the trick there is expected. Who's expected? When we talk about the market's expectation, what does that mean? Well, today we're going to try to put some meat on the bones and show you three interesting examples that show that the role of expectations is complicated, tricky, and quite frankly, risky. So let's go to the computer and get started.
Go ahead.
So here we are at the computer, and we're going to take a look at three companies today. And here's the first one. This is a company that obviously has done very well. These are the earnings, the trailing 12-month earnings for the last 5 years, reported quarterly. And you can see this company has grown consistently and grown quite dramatically. 5 years ago, the earnings were about $1. Now they're more than $11. So with that sort of growth in earnings and that sort of performance, you'd expect the stock price to have done very well. And it has. Like any stock price, it's been a bit volatile, up and down, but it's risen right along with the earnings. So as the earnings improved, you would think the expectations improved and everything was great for a while. Now here at the very end, we've had a couple other flat spots for this company, but here at the very end, earnings actually decline a little and flatten out. Well, what happened to the stock price? It has absolutely collapsed. The stock is trading today at about the same price it was 5 years ago when the earnings were less than 1/10 the current amount. So back here 5 years ago, it had very low earnings, but apparently big expectations. Now it has more than 10 times the earnings, but the expectations have collapsed and it's trading at the same level. So this shows you the incredible difficulty of predicting and dealing with market expectations and how dramatic the movements can be when expectations change. And that's really for two reasons. When expectations of future growth fall, they're often accompanied by expectations of greater risk. You put those together and you get a collapse in the stock price. This company is Netflix. Let's look at another company. Like Netflix, this company has had consistent earnings growth from about $3.50 up to $13.50. A little hiccup here along the way, but basically very consistent growth. And so you'd expect the stock price to be rising as this growth led to expectations of yet higher future earnings. And that's exactly what happened. Again, there's the volatility you always see in stock prices, but the trend is definitely up right along with the earnings until it's not. And this company as well is now trading at a price approximately equal to what it was 5 years ago when earnings were just a small fraction. And this company is Facebook. So we're talking about, when you see this kind of drop, we're talking about $500 billion decline in market value. And again, early on, it was high expectations but low earnings. Now it's high earnings but lower expectations. Now both Netflix and Facebook, despite the current drops in their stock prices are still very profitable, well-run companies. They're not going to disappear. But the story can be quite different when you don't have the consistent earnings of a Netflix or a Facebook. So let's look at one more company. And I'll tell you the name of this one right out the chute. This is Peloton. And this is the earnings of Peloton. So notice this is the 0 point here. So early on, the company was losing money, then it was making a little bit of money, and then it started losing significant amounts. So let's tie the stock price to the earnings, recognizing that the stock price depends not on the historical earnings, but the expected earnings. So let's put the stock price on there. Here's the stock price of Peloton. In the early days, it's around $20. Even though the earnings don't rise much, during the pandemic years, there's a growth story that all of us are going to be riding Peloton bikes and buying Peloton time for the classes and so forth in our bedrooms rather than going to gyms or working out outside. And the stock price runs up by a factor of 8 to almost 160. Now, even though the earnings are still going up, the story starts to fade. The expectations start to fade. And then when the earnings drop as well, the stock price comes all the way down. It's now in the 17s. It's less than it was years before the pandemic. Or a year before the pandemic, excuse me. So this is another example of how a company can appear to be very successful based on its stock price, but it's all driven by expectations. And while those expectations are in place, Peloton can sell stock to raise all the money it needs. Other counterparties are willing to accept its liabilities. But if the expectations fall, then it becomes very difficult to sell the stock. People won't take your liabilities. And in the 2000s, about 90% of the companies that were built on expectations failed entirely. Now, hopefully, Peloton won't be an example of that. It still has a core business, but there's a real risk that it will. So what's the bottom line? The bottom line is that when we say the stock price equals the present value of future expected earnings, you have to be very careful in thinking about expectations. As we've shown today, Netflix today earns 10 times what it did 5 years ago, and yet trades at the same stock price, because back then expectations were very high and now they're much lower. So when you talk about attempting to fundamentally value a stock, you have to think very carefully about what the market expects and whether those expectations are reasonable. This has been Reflections on Investing with the Cornell Capital Group.